Welcome to our video series entitled Industry Viewpoints, brought to you by the American Bankruptcy Institute. Each segment will feature an expert providing views on the current state of a particular industry with a focus on what lies ahead. My guest on this edition is bankruptcy lawyer Evan Miller, a director of the Bayard firm from Wilmington, Delaware. Here at ABI's Winter Leadership Conference in sunny Palm Springs, California, Evan was one of the experts on a very popular panel dealing with cryptocurrencies and blockchain, the single most prolific source of big new Chapter 11 filings in recent weeks. Now, Evan, like many people in this country, I have been fascinated by the progress, the meteoric rise, and the rapid decline in the crypto and blockchain industries. And what amuses me is this, Evan. Crypto was invented supposedly to be a means by which people could hold assets, trade assets directly without going through a third party, and could hold them without benefit of a financial intermediary like a bank or a broker. Mm-hmm. That's the theory. Great theory. Particularly so, I guess, if you want to do something illegal. However, what happens? Everybody turned around and started using financial intermediaries anyway. Mm-hmm. They weren't banks or brokers. They were largely, if not entirely, unregulated, but they still turned around and used financial intermediaries. And the result is, as we've seen in these bankruptcies, there have been spectacular losses that never would have occurred if people had used banks or brokers. So, Evan, the question I have for you is, how is this possible and why did it happen?
Well, and there are a number of different answers that you could provide to that, but I think that generally speaking, as the popularity of cryptocurrency grew, then the market to provide easier and easier and easier access to cryptocurrency grew with it. And that's the market gap that these exchanges were designed to fill. And they provide an ease of access and an on-ramping avenue for general consumers all the way up to institutional consumers at this point, or institutional investors to acquire cryptocurrency.
Well, it's a great idea. What went wrong?
Well, I think what went wrong is that the terms of these agreements, when you try to trade and invest with these exchanges, is that there's a lot of fine print. And like with many other things, crypto or otherwise, the fine print is defining some very critical rights for these different parties. And the fine print of these agreements is saying that basically when you keep your cryptocurrency on the exchange, for instance, or if you're keeping XYZ digital assets on this exchange, for the NFTs or take your pick, then a lot of times when these parties, even very sophisticated investors, are signing up for these agreements, there are clauses that are essentially saying that you are forfeiting your rights to the company being the exchange in this instance, to do what they want.
Well, translating all of this fancy pages of disclosure into a few words, it sounds to me as though customers, whether they knew it or not, were making unsecured loans to these exchanges. Is that essentially what it came down to?
Depending on the different kind of assets that they were keeping on the exchange, I think that's true. And so most of these exchanges too are differentiating between funds that were kept on the exchange or kept elsewhere as compared to the actual crypto assets. With some of these entities, which has become an issue in the Celsius bankruptcy, for instance, or Voyager bankruptcies, we've seen that the company itself had relationships with outside banks that basically provided FBO accounts, or for the benefit of accounts, where customer funds, the actual cash that they kept on the exchange, to eventually acquire the crypto was kept in separate segregated accounts. Those accounts basically treated the customer, or the consumer, we should say, as the actual party with the bank account, and so that money has been protected. At least that was one of the initial rulings in the Voyager case. It's a different story for most of these exchanges across the board as to what happens with your actual crypto that you keep on there. And most of those say that they are allowed to take your crypto funds and use them to exchange, to lend out, and not totally dissimilar from the way the banks, when you provide money to a bank account, that they have authority to utilize your cash and your deposits to lend.
But you've got tight regulation, and you've got FDI insurance, FDIC, or if it's a broker, you've got SIPC, with tremendous amounts of protection and coverage. I mean, to me, all of this is astonishing, that there could be such catastrophic losses. And as you said, many of these were not just, truck drivers. There were some sophisticated investors. Is that not correct?
No, that's absolutely correct. I would say if there's one of the most astonishing things about this 6-month stretch where we've had this this prevalence of cryptocurrency-related bankruptcy filings, has been that, to your exact statement, that you have people that are invested for maybe $100, $200, all the way up to 9 figures worth of debt, that have all essentially fallen victim to the same issues. And a lot of that again gets back to the question of ownership, and when you get involved with these exchanges, not having a full understanding of what it means to actually own your cryptocurrency.
Yeah. Well, to me, it's remarkable that this is such an unregulated industry. Do you think there is going to be regulation or legislation to come out of this mess in the next 1 to 2 years?
I think that I think it's more likely than not that something comes out of this. I don't think it's going to be probably as drastic as we might think, here and now, but I do think there is going to be some kind of oversight. I think that you already have certain exchanges have already been trying to lead the pigeon, so to speak, where they have been trying to be as compliant as they possibly can and treat themselves as if they will be completely and formally regulated at a certain point in the future. And I also think that there's been a market reaction by some of the surviving exchanges to try to diffuse some of that tension and that desire to overly regulate here, because.
Well, by the way, thinking of the FTX bankruptcy, it's been in bankruptcy now, what, 2-3 weeks? Not very long.
Yeah, about a month.
A month? Okay. There are, somewhere in the neighborhood of 2,000 docket entries. Now, is that all litigation? Is this one of the most actively litigated bankruptcy case in the history of the world, or what is all of this activity on the docket?
Yeah, well, with FTX, the docket's a little bit smaller. Celsius is a docket.
Oh, Celsius, excuse me, you're right.
Yeah, Celsius filed back in July or over the summer, and they have had, I think they're approaching 2,000 entries at this point.
Oh my goodness.
And I would say the overwhelming majority at this point of those filings are just pro se consumers, that had accounts with Celsius, that had accounts that are just simply trying to recover amounts that they had invested in various programs that Celsius offered. And it just this past week, actually, with Celsius, there was a hearing, a long-awaited hearing on Monday and Tuesday, where they were addressing a request by certain parties to be able to withdraw their funds from accounts where you had language actually that said categorically that these remain consumer funds, these remain property of the consumer. So you didn't have that question, at least facially, you would think, about the issue of whether or not it was estate property or not.
Yeah, but then you've got the question of how many people are claiming the same property.
Well, and in that instance too, they had, one of the reasons the judge could not grant, at least at this stage, the actual request, was because they said that the funds that were in that protected account came from accounts that were not protected. And so basically accounts that where it was the opposite, where it was unequivocal that it was debtor property, and that the accounts that were unequivocally consumer property, because they had been transferred there in the previous 90 days, there was preference risk.
Ugh.
And so they wouldn't, the judge could not grant the relief on that at this point.
Oh gosh, this is enough to make a grown man cry. Where do you think this is? Where do you think this industry is going? Is it an industry that can survive this kind of scandal, or is there such an eagerness by people to invest that it's going to survive because of the demand pull?
I think it's going to survive, and I think it's actually going to. I think it's going to thrive in the long run. Personally, just as a point of comparison, when the Mt. Gox exchange collapsed several years ago, that accounted at that point for 70% of market share of parties that were trading in cryptocurrency. By contrast, the FTX and the FTX bankruptcy and the ones that have preceded it combined account for only 20% of the market share at this point, or thereabouts. So on a percentage level, at least, it's smaller. It certainly feels bigger now because the market has grown exponentially, and you're in the, I mean, just up until several months ago, we were talking in the $1 trillion market cap range. So I think it's going to survive. What I see happening are several-fold. I think that the exchanges are going to have to be more transparent about their assets and their liabilities. We've seen some movement by some of the surviving exchanges already in that direction. And I think that will provide customers with at least a little more comfort that they know that if I put $100 worth of collateral into this exchange, I'm going to get $100 back.
Well, but are these, because I've been reading about that they're having audits, but are these traditional audits like we would think of an audit of a bank?
I think they are different. And at this point, I think they have a lot more to go because they've only really assessed the assets of these companies, and they've concluded that they are over collateralized based upon what's in there now. They have not done a full liability analysis.
Well, my goodness, what use?
Yeah.
What is the use of knowing what your debtor's assets are if you don't know what the liabilities are? I mean,
a true ABI statement. Yeah.
That's crazy.
Yeah.
That is just crazy.
And so hopefully these exchanges that have pledged to do full, including liability surveys by these, or audits rather, will honor their word and do that.
Well, I wonder if you end up with these exchanges that are as audited and transparent as banks and brokers, I wonder whether that's going to inhibit them from doing business the way they want to do it, and whether it will then be a profitable business model.
I think they can still do it because I think that even prior to all this happening, it was already moving in that direction because the U.S. already had, just taking the United States for example, they already had more stringent requirements for exchanges to do business in the U.S. That's one of the reasons why with FTX, for instance, there was the FTX US arm, which actually is a much smaller component of the whole FTX picture. And the same is true for another exchange, Binance. Binance has its own US arm. So a lot of exchanges, in order to access the US market, had to already begin complying with certain US requirements. So I think you had a trend going towards that anyway, and especially with know your customer issues. And it hasn't seemed to slow down, the rate of adoption.
Well, maybe what it amounts to is that the first of the exchanges to make itself just like a bank or a broker. Maybe those exchanges are going to have a real advantage in the marketplace, and maybe they will be the profitable survivors. Let's hope so, because that certainly would
it very well could be.
Could save a lot of the heartache that, it just makes me want to cry when I read stories about some working person who lost, her entire life savings in one of these things.
Yeah.
I mean, in a way, it's almost criminal.
Well, and I'm hopeful too that one of the things that comes out of this is not only better behavior by these exchanges, which we certainly all hope for, but with respect to actual consumers, the actual consumers themselves, there really are ways to protect yourself from at least some of what's happening right now. Like, for instance, keeping money on the exchanges, again, always risky. These are not, to your point, these are not banks. These are not meant for holding funds or protecting funds. They're not generally, certain exchanges have FDIC protected accounts, up to $250,000, those protections. But a lot of them don't, and other ones, especially with respect to the cryptocurrency side of it, keeping your cryptocurrency on these exchanges is part of the issue, such that when they collapse, or even in the lead up to the collapse, I mean, they had stopped withdrawals and things like that. So one of the takeaways, I think, if you're going to get involved in this space is be proactive and think Murphy's Law, essentially. What's the worst that could happen here? And unless you're a day trader, I mean, there's really no need to be keeping any of your cryptocurrency on these exchanges. You should take them off, and then you can put them on your own, what they call cold wallets, which are completely disconnected from the exchange, and then that becomes yours to administer.
Well, that's very interesting, Evan. That's the most important thing you have said since we began this interview. You have just told us how someone can participate and trade on these exchanges, but then protect yourself, it sounds like, almost absolutely. How, again, do you do that? Tell me.
Sure. So it gets into the way in which you can store your cryptocurrency. There's really three options. The first option, which of course is the most risky, but the most convenient, is keeping it on the exchange.
Yeah, okay. Yep,
and we see what can happen in the worst case scenario.
It's all gone.
There are what are called hot wallets, which are essentially encrypted online addresses to which you can send your cryptocurrency. They call them hot because they're still connected to the internet, which can be hacked. It's a better layer of protection from having them on the exchange because, again, you've created an ownership distinction.
Yep.
But it's still not. You're still connected to the internet. There's still risk.
Yes.
The safest method by far is cold wallets, which are essentially, and there's a whole variety of ways they do this, but the most common method is you connect essentially what amounts to a glorified flash drive to your computer, and you transfer your cryptocurrency from the computer, from the exchange rather, onto this flash drive, and then you unplug it. It is disconnected, and the crypto is stored on this flash drive.
But I guess don't lose the flash drive.
Don't lose the flash drive. There are some horror stories out there about that right now, where people have lost tens of millions of dollars stored on these flash drives.
Yeah.
There's a story in Britain right now. They're trying to have an entire landfill investigated to find this one little flash drive that has something upwards of $100 million on it.
Oh, my Lord of mercy.
So you have to keep track of it physically and also remember what your passwords are. And normally these are very heavily passworded devices.
I just love this. This, 20 years ago, we never would have thought there could be such a thing.
Yeah.
This is wonderful. Well, Evan, I tell you, this has really been a marvelous time I have spent with you, and we thank you so much for your insights. And because it is such a prominent topic these days in bankruptcy circles, crypto, you can be sure, will be a topic at every upcoming ABI conference. To that end, have a look at the website, abi.org, and you'll see a list of our upcoming conferences and the topics to be covered at all of them. And we thank you in the audience for tuning in. The Industry Viewpoints series in upcoming days and weeks will have us talking with other experts about the future of industries that are affected by our turbulent and very interesting economic times. Until then, be well, stay safe, and good day.